You're kind of freezing. Is it my
Yeah, it might be on your end. My connection looks good today, at least. We'll see. Hey everybody, we're here with George Coyle, going through a couple ideas today. One was passive versus active. Something that we've been, we've talked about this before. If you've been on my channel for a while, you've heard me talk about this, but George actually has written stuff about this. George is actually very well versed in this subject. So, George, what were you seeing the inflow? You mentioned the inflows when we were just off mic a second ago. So what was the inflows you were seeing recently?
Actually, it was a post from Jesse Felder, who I think is a newsletter guy. But it says, I'll just read it verbatim. In the past 15 years, there's been 5 trillion of inflows to passive global equity funds versus 2.5 trillion of redemptions from active funds. And I thought it was really interesting because I wrote this post, I guess it was back in, January of this year. So it's a while ago. But I was listening to one of the Capital Allocators podcasts, and Dmitry Valyazny was on, and he was saying that the best environment to be a trader, money manager, whatever, is when there's a lot of generalist participation in a strategy and there's a lot of money coming into a strategy, which makes sense, right? But anyway, I sort of went back in time and I studied that a little bit, and I found that in the 80s and 90s, the futures traders, which is kind of my favorite topic, right? That space went from about $100 million to about 14 billion, which in today's terms isn't a lot of money, but I think it's basically exponential growth. I don't think it is. It is. So to some degree, it's like maybe those guys were so successful with that strategy at the time because there was so much money flowing into the strategy, right? And similarly, I found something in Going Infinite, which is Michael Lewis's book about Sam Bankman-Fried. And basically it said that Jane Street had gone from a few traders with a few $1 million in 1999 to roughly 200 traders working with several $1 billion. They said one of the big reasons was ETFs, whose global value had gone from less than 100 billion to 2.2 trillion. So you sort of find this pattern of when money is flowing into a space, maybe that's more a function of why you find success with a given strategy than anything, right? I guess potentially Fed liquidity, but that's another story. So anyway, when I traced it back and found some examples historically, it was like, yeah, the people that have a bunch of generalist money coming in tend to do very well. And so when I saw that post about, the passive buy and hold crowd having way more money flowing in versus active, it just got me thinking, well, that's probably why the rock stars of finance these days are just the buy and hold guys who go out and say it's going to go up forever. And you probably know my opinion on that is maybe, like not if you look outside the US or outside the last 100 years, but it just got me thinking. And I guess part of it was, I think that's an explanation of why it's been so successful, but it's also, I start to wonder, like, how long can that go on? I mean, we saw when Japan raised interest rates, clearly a lot of the global risk trade was born of zero funding in Japan. And so everybody sold at the same time, essentially. The Schwab and Fidelity platforms, both of them actually crashed on the same day, which was August 5th, which is kind of like, oh, that's strange. So many people, I guess, were trying to log in. But anyway, yeah, I guess I've just been thinking a lot about that, and partially 2 parts. One is, if you can figure out where the money's going to go and get there early and don't stay too late, you'll probably do pretty well. 2 is, excuse me, how long can this buy and hold avalanche of capital into passive go on? And I don't know the answer, but those are, I guess, 2 things I've just been thinking a lot about, that the post from Jesse Felder kind of got my gears working on it. So
I was talking to a guy recently, what's his name? Stephen Weitzel. And that was in Sonoma for the portfolio accelerator with all-star charts. And we were having a conversation and we got onto this long topic about the 60-40 portfolio and this idea of passive forever and ever and ever. And it was, he had, basically he said, I started to write a paper and I loved the title for this paper, which was called Pavlov's New Dog. and basically stating that, how do you get people out of this thing that they've been doing for so long at this point? They've continued to love this idea of 60-40 portfolio. And honestly, yeah, they've been really right. 82 to basically 2020, they were right. And he basically said, no matter what, people are going to still believe any dips in the 60-40 portfolio, any dips in bonds, just continue to buy. It's going to turn around at some point. And so this idea of passive is kind of insane at this point, because once again, if you understand cycles, and also the bond market is very cyclical. A lot of people don't know that, but the bond market is so cyclical. You could look at it has 40-year cycles. You look at a 100-year chart, a 200-year chart, a 300-year chart, even, you can see this massive cycle that happens in the bond market. I'm not saying that's always going to be perfect. I am just saying that it's right around 40 years. And so we see that basically a blow off top in yields in 1982. We have that basically head into a downtrend until 2020. And so every one of my parents, or anybody who's from the age of 20 to basically 50, anybody's parents in that time frame, they're all telling you, hey, I just put my money away. I don't do anything. It's been great all these years. And they're right. It has been great. However, now it's not so much. The bond market's been in this nasty downtrend. 2022 was probably a eye-opening year for a lot of people who have been doing passive for a long time, which they've been in that scenario where they're right forever, but then there's a year where both are down massively. The bonds were down 20%, stocks were down around 20%. So, I mean, if you're looking at it, you have to understand there's going to be either you got to be a little bit more active, or you've got to start thinking of different ways to shape your portfolio to outperform.
I mean, clearly it behooves both of us to talk about active, and it would benefit us if it came back. But I might want to go get a splintered soapbox here and preach for a while. Yeah, I think the biggest thing about the buy and hold argument, you see these charts of the S&P over the past 100 years or 200 years, whatever it is, and they say it always goes up. But it's like, if you look outside the United States, or you look beyond the past 100 years, that's not true, right? It's not true to the same degree. It was Triumph of the Optimist was the book. And they did a study from 1900 to 2000, and they found that the United States stock index, basically average return, was about double the average of all the countries in their study. So the returns that we assume are an outlier, right? And then if you go back beyond 100 years, I mean, whole financial regimes get wiped out. So I guess what I see with buy and hold is it's a huge bet on the future, looking a lot like the relatively recent past, at least the last 100 years, which sounds like a long time, but it kind of isn't. And I guess for me, and I know there's different types of diversification, but diversification is also a bet that things will play nice together in the future like they did in the past. And they won't necessarily, like you pointed out. The bond market's been, it's still in a drawdown from, I guess, 2020, essentially, right? So what if people lose faith in the United States, and that causes yields to spike, which causes business to have difficulty funding, and both of these things go down together? Then diversification really doesn't do anything for you. It might actually make it worse, as you just sort of say, oh, well, they're gonna play nice together. But we're veering all over here today. But one of the things I'd like to bring up is, in this sort of origin study that I told you about before, where I'm studying the early years of successful people, and I'm finding a lot of commonalities. They all get rejected for years trying to raise money, and usually they have some kind of big investment gone right that enables them to quit their day job. But anyway, what's interesting is I've been reading Bogle's stuff and listening to it. He's Boglehead's Vanguard, John Bogle, or is it Jack Bogle? I forget his first name. Anyway, but everybody has like a very plausible argument for what they do, right? If I've studied Buffett, and you look at him, and his stuff is compelling, and the trend followers story is compelling, even though it's non-narrative narrative, and Bogle's argument's compelling. And so I just find this interesting, because I think you ultimately get to a point where you have to say, which one of these do you believe in? Which do you have faith in? Because they're all going to be quote unquote right at different times. They're all going to be wrong at times. What time frame do you look at? By what metric do you measure success? But I just found it very interesting because it's like, oh, you're listening to this, you're saying, yeah. But to me, the biggest thing I've found is just going back to those trader principles. It's like, if you just cut your losses, then you really can't blow up in the same way that, a buy and hold guy who bets that the future will look a lot like the past. If it doesn't materialize, they're just waiting and hoping, right? Meanwhile, if you cut your losses, it's a different story. So a bit of a meandering rant here again this week, but I just thought that was interesting. It's something I'm thinking about in the last week, and how all of these different arguments are relatively compelling. But I think one of the things that I do when I study them is I look back, and Bogle talks a lot about the math and the stock market and how you can't deny arithmetic, but it's sort of like he's looking at a sample size of the last 100 or so years, which may not be indicative of the future. So I keep coming back to this idea of the only way to guarantee that you protect against an uncertain future is to cut your losses. And even then, like if the government fails and all the banks fail, you could be in trouble. But at least within sort of a lack of failure of the system, cutting losses will help protect you from a strategy going off the rails. So I guess I'm content to die on that mountain potentially. Anyway, I'll pause there and see if you have thoughts on that.
No, that's great. And, good comment, Dave. Moving on, better than trying to prove that you're right. But yeah, I think in general, it's the biggest thing to kind of figure out about trading, and protecting wealth over the long run. Yes, if there's always the argument, if you threw your money in the S&P 500 for, the last 100 years, you'd have this much money. I'm not saying that's completely wrong. I'm not saying, it's a terrible idea. I think most people, they'd be better off either giving their money to a manager or putting their money into something like that and walking away, rather than trying to time the market, do something that you're not that interested in. But if we look at it just based on what you're saying, like the diversification aspect, all of these have gone through major periods of underperformance. If you look at the bond, and that's the other thing, for example, do we see bonds getting lower than 0% in the front end part of the curve? That's something that you have to ask. So can the short end part of the curve make a new high? All of these things have to, you have to ask yourself these questions, and the answer is probably no. So how low do they have to go until you are interested in buying something for a major trend that could be secular for 40 years? So basically we're talking about and I'm not saying that, and neither one of us are saying that as a trader. For example, I'm long the bond market at the moment. I don't like the trade. I don't think it's something I'm going to be in for the next 40 years or anything, but it's a trade. We're going to see rallies in the middle of this downtrend. Does it mean that I want to hold bonds for the next 40 years? Absolutely not. So you have to really think about what the past looked like in reality. Like you said, things have massively changed over time. What if the U.S. isn't the leading stock market? Like you said, it crushes the returns for everybody, and that's been for years now too. It's been crushing everybody else's returns. Most countries, yes, there's some who do outperform, but it's rare. But really, the U.S. has kind of been the place to put your money. But what if that changes? And the U.S. people, we have a very big advantage. One is that not only do U.S. citizens go, I don't want to invest in anything outside of the U.S., also globally, people like to invest in the U.S. as well. So we have this massive advantage right now. But what if that changes? What if that doesn't last? These are all questions you have to ask yourself if you're going to put your money in something and then walk away for 40 years.
It's an interesting point, but I guess it gets back to that inflows argument, right? Like, where does the money want to go? It wants to go to the United States predominantly, and it wants to go to stocks and bonds because that's how the retirement system is sort of designed, or the investment system. If most people make a lot of money selling a business or lottery or whatever, you rarely hear him be like, "Oh, I'm going to go out and short the Japanese yen against like the Australian dollar." It never happens, right? It's like it's all stocks and bonds, and maybe that makes sense, right? Because you are taking a stake in theory, a profit-producing entity and whatnot. But I guess the larger point is the money has been coming to the United States, stocks, bonds, for a very, very long time, and that's probably what's made it so successful. I mean, I think something like $500 billion a year, by virtue of how the U.S. retirement system works, goes into stocks and bonds on the long side, and that's a pretty strong tailwind. I'm not sure how you measure central banks' activity in currencies, but yeah, the 401ks, the IRAs, things like that. It's just putting that money into stocks and bonds and their target date funds, and passive is overtaken active. So it's just interesting. I mean, one, when it reverses, it's going to be like a scary run for the exits, I suppose. But two, that money, that's a big tailwind. I think it's the biggest tailwind I can find anywhere. Yeah. On that note, one other thing I've been thinking about. So I was studying Buffett. He actually had some hard times in the beginning of his career. Didn't do so well as a stockbroker, but I've watched a lot of videos, and he had one, and quoting this from memory, so it's not a direct quote, but he talked about, what if you only had like 20 choices for investments in your career? Like you could pick 20 things and that's it. And I thought that was really interesting. And I think he meant it as like he would buy this stock and Bank of America and whatever. But I sort of thought, how would I deal with that? And the answer that I came up with is I would basically design some kind of system that was predicated on the idea of getting out of losses, or maybe a handful of systems, but it wouldn't be 20. And that was kind of Buffett's point. He's like, you'll be amazed if you start to think about the world like that. You won't use all 20 slots. You'll end up using a couple of them. And to me, it was an interesting thing, because it was like, I'd probably want to align with stocks, because, you're taking an interest in a profit producing business that deals with how the economy works. We can't all do everything for ourselves, so we specialize and charge fees that allow profits. But I definitely want to put something on that could cut the losses, not to be a broken record. Because if you said, George, what company do you want to own for the next 50 years? I wouldn't have any idea. I mean, if you study the history of businesses and you read about old traders and the stocks that were big deals then, I mean, they're not around anymore to a large degree. Although there was that Financial Times thing that pointed out that the best stock was Philip Morris, which had returned 265 million% over the past 100 years with a 16% CAGR. But still, like, how could you pick that right company? I mean, I'm not sure I could. If you had told me, hey, tobacco is going to be the best return ever, even though it kills people and everybody knows it, I'd have been like, no way, right? And yet there we are. So I guess this idea of, say you had a few choices, what would you design? Why? I think it's a very interesting thought exercise, because I did find I wouldn't do maybe 5, and they'd probably be subtle variations on the same theme with different leverage ratios, so that I could, in theory, toggle between them when opportunity presents itself, right? Meaning, like, if the stock market's at a 50 times earnings multiple and the Fed is pulling liquidity out of the market and there's a war and stocks are volatile, I probably wouldn't want to be aggressive. And if it had crashed and they're creating all these acronyms and flooding the system with liquidity and it's at 2 times earnings, I'd probably want to be more aggressive. But either way, I guess the larger point of interest to me was just this concept of, say you could only do a handful of things, what would you do? And I obviously just went through what mine would be. I don't know that those are right for everyone, but I think it's an interesting thought exercise. So,
no, I like that, because for me, I guess I think of it in a similar way. Like, even as a trend trader, like, you only I always tell people when they're starting, like, find 20 things that you want to trade. Even go to 50 if you really want to. But most of the time, you're only going to have signals for maybe 10 of them at the most. So you have to kind of think of these things in a very interesting way. I mean, where I cut my teeth in finance was building portfolios and the idea of the long-term portfolio. And like, what's funny is, and I was just talking about this today with Sam.
Do you mean like stock like single stocks?
Yeah.
Or, okay.
No. So like asset allocation. So we'd go, some bonds, some stocks. Like, how exactly would we build this thing out to outperform for the next 1 million years or something, like, so it was all, that was always the big question. So we'd sit there with our head down, you find the permanent portfolio, which is the idea of buying some gold, some stocks, some bonds, and some global stocks. So you would do that, and you go, okay, well that's good. Actually, it looks, actually going back, if you go back, like that has been a great portfolio over the long run of time. So if you actually look at that, that's a really good idea. And then if you look at it like Ray Dalio, he added the idea of having like a little bit of commodities exposure. I think he uses like 7% or something. So 7% commodities exposure. I think he has 10 or 15% gold, and then stocks, bonds, maybe some global stocks or emerging markets too, I think he has. So, I mean, you can come up with some of these ideas, and they really do smooth out your portfolio returns. So it's like you said, like there's so many different ways to look at that. As a systems trader, there's one way I look at it. And then as a person who built portfolios to last in the long run, there's another way to look at it. And I think a lot of people don't understand, like there are alternatives to a 60-40 portfolio. People always look at it and they go like, oh, well, it's stocks and bonds. And I mean, if you talk to a fiduciary, the first thing they say is, oh, how old are you? And you go, I'm 20. And they go, okay, great. You're going to be 90% stocks, 10% bonds. And then you go, I'm 90 years old. They go, okay, well, you're going to be 90% bonds, 10% stocks. And they base it, and it's actually based on your age. Like they always say your age should be the amount of bonds you have and so on. I mean, it's all ridiculous. For example, I had a conversation with an older person, and this was in 2020. It's actually my fiance's mother. And we got in a huge argument because I said, hey, like your fiduciary put you all in bonds because of your age, but bonds might be one of the worst places to be right now. The Fed's created this much liquidity. We're giving money out to people like crazy at the moment, PPP loans and so on. Inflation could take off. It would absolutely destroy your bonds. And once again, it's just, this is the way it's been done for years. So it's kind of like where it gets to that Pavlov's new dog idea. They're trained that way. They're trained to do that. They go through school. They learn this is the only way to do it. But I really like this I could talk about this stuff for way too long and bore everybody to death about it. But I absolutely love this type of conversation of asset allocation, because it's really important if you want to gain wealth, hold wealth for the long run. This is an important conversation.
Yeah, I think it's interesting because that whole thing, I mean, it's mostly modern portfolio theory, right? There's a couple other versions, there's Black Litterman and whatever, but it's like volatility is risk, which I think is suspect, because if you have a portfolio that goes up 10 flat and a portfolio that's up 5, down 5, those have the same volatility. So in theory, they have the same risk, which I think we'd all look at that and say, I want the one that goes up 10 and it's flat. But the bigger thing is like that idea of, 90, 10, 10, 90. It's all predicated on the future looking like the past. It's all this, okay, you're this age and you need to get here and you need to have these, going off screen, assets for this amount of time. And A, I mean, there's 10 moving parts in that, so who knows, right? But B, the supposed return is based on the idea that this is how stocks and bonds have played together over the past 100 years. And so we'll just make the assumption that's potentially a quantum leap that that's how they'll play together in the future. So I keep going back to that, like do that, but have a way to get out if you're wrong. Because if you think about it, like most assets have been steadily going up for the past 100 years. I mean, I hope it doesn't happen, but like in theory, in the future, that could go the other way or go sideways. And if that does happen, what protections does asset allocation have against that if they all fall in unison? Really nothing. But then I guess there's other portfolios that you can design for different regimes too. One thing I think about to kind of change gears is this idea of the end of the world portfolio. And what would you do? And I think the answer is you just spread out as much as you possibly could and just hope that something survived, at the end. So it'd be like some stocks, but this country and that currency and a bank account there, and some gold and some Bitcoin and just all of it, and then just hope that it'll all come back. But if you try to do that all the time, you're going to make nothing. You're going to make a couple percent. So yeah, anyway, I've thought a lot about this stuff, and I guess to me, I don't know that I have the right answer, but the best answer I've found is just probably adhere to what's worked historically, but throw some kind of approach to get out if it goes the other way. Because I think, yeah, to me, it's irresponsible not to, because you just don't know what's going to happen. None of us do. So, and whether that's a trend system or a trend model applied to some kind of allocation, I mean, I think they should do about the same thing in theory over time. So,
no, that makes sense. So, but yeah, unless you have anything to add on that, we're gonna cut this here. We're gonna try a little shorter format today. So people, please let us know if you like the shorter format, longer format. We're curious. So George and I are just starting the show. We need some help from you guys to just let us know what you guys want to see, what you guys like, what you guys don't like. Feel free to hate on us. My hair is usually a mess sometimes. Feel free to talk about that. George got a nice slick back today. Talk about George's hair. Whatever you guys want. My coffee cup being multicolored, whatever you want. It also says no kvetching on it. So
no kvetching. Wow. I got my grass drink residual. I drink these powder greens every day, trying to live long enough to catch the big trends.
That's what it's all about. All right, guys, thanks for joining us, and make sure to watch the replays, and make sure to follow George. And if you're on YouTube, hit the notification bell. We got some no longer. Please stay longer, better for sure. We'll be with you next week. We're gonna try this format, see what people say. But thanks. We're gonna take that to mind, and we'll talk to you guys soon.
See you guys.